What does it look like for someone who wants to think about selling their business?
An exit is not a single time, it's not one single event. It's multiple years, sometimes multiple years in the making.
You might be losing, 30, 40% in taxes sometimes if you're not prepared properly.
There's multiple steps to get to that point.
There's something called a lifetime capital gain exemption.
But, not everyone's aware
Yeah.
that you have this exemption.
There was about $9 to $10 million of capital gain exemptions claimed. That's one deal in my experience in the recent times where the structure really killed the deal.
That's when some owners approach us looking for, or their advisors looking for some advice on that standpoint. There's a lot of negotiations that take place before anything is signed.
It's a lonely space to begin with.
Yeah.
You can't freely talk about it to your people. The child has to own the shares generally on an active business. The rate
Yeah.
can be as low as 12% in Ontario. The business runs on its own. You spend thousands, but it'll save you potentially millions. So let's talk about the process of what does it look like for someone who wants to think about selling their business, and what are the things that logistically need to happen, even if you think about a future exit.
Yeah. Well, I think it's important to say that an exit is not a single time, it's not one single event. It's multiple years, sometimes multiple years in the making. From a founder perspective, sometimes you don't even have a buyer and you're looking for a buyer. And even before that, you're looking to see if your business can sell, right? Like, is someone willing to pay a premium
What is
price
the
for my
value?
business? What's
Yeah,
the value?
what even the value is.
Yeah, exactly. And then, is there value to it? What am I selling and to whom I'm selling it, right? Like, is there a buyer out there that's willing to pay that price? That
Yeah.
can take so much time. And even thinking about if you are going to sell it, how are you going to offload all the operations? Is someone going to take over? What do you need to do? What things do you have to put in place for that to even happen, right? Like, there's a lot that happens beforehand.
Yeah.
And then usually they approach an advisor looking for some advice when
Yeah.
they're selling.
Yeah, typically, selling even into the future, you're just having a thought about it. It's a lonely space to begin with.
Yeah.
You can't freely talk about it to your people, your employees, because they might interpret things differently and might have job security issues.
Yeah.
And so, when you're making these types of decisions, you have to do a lot of things in the making over a period of time and transitioning to it.
Mm-hmm.
Oftentimes you have to hire strong team members, or in your company staffing that's going to be slowly taking over what you do, and then really removing yourself out of the process. So then it makes a business case for somebody else who might buy you out. Then they might see some value to it. It's like, hey, the business runs on its own.
Yeah.
Whatever income it makes, it doesn't require the current owner to be so much part of the business all the time.
Yeah.
So that is, like you said, it's right. Like, it's a process.
Yes.
It takes time to figure things out, what needs to be done. But oftentimes you have to see, well, is it even a sellable business? And how do you even ascribe a value to it?
Exactly. And that's why I think that's when some owners approach us looking for, or their advisors looking for some advice on that standpoint. And then when they start looking for a buyer or find a buyer, there's a lot of negotiations that take place before anything is signed, just to see if there's even interest. And those conversations can take time because there's a lot of questions that come up.
It takes weeks, months,
Yeah.
sometimes multiple people you
multiple
try it
years.
out with.
Mm-hmm.
And, but it's like a marriage, so to speak, right? Like,
Yeah.
you have to see if that person is a good cultural fit, will be able to move the company forward if you're really passionate about what you've started, if you're the founder of the company.
Yeah. And then from the buyer perspective, there's a lot of due diligence that occurs because they're asking a lot of questions
Yeah.
about the operations
Yeah.
and what's happened
I
in
guess
the past.
we should talk about, like, what type of buyers are out there.
Yeah.
I see it like there's a succession that can happen from within.
Yeah.
You can have a succession from like a buyer could be a key employee who you can coach, train, and eventually have them take over the business. Sometimes it's also succession within the family. So if you have a child that's interested in what you do and you want to have them take over the reins of the company, that's like another way. Like, what other buyers have you seen in externally, I suppose, if it's not
External, yeah. If it's externally, it could be someone you've worked with in the past, that's maybe buying you out. A larger acquisition in that way. It could be someone unrelated entirely that you don't even know. And then I think that's when all the due diligence questions come up a bit more, because they're trying to figure out if this makes sense for them. But yeah, how about you? What else have you seen?
We generally see like there's two types of buyers that are external. Sometimes it's a competitor who is strategically trying to grow by buying out the others in the same market, especially if the market is very saturated, where there's too much competition, and where what you do and the only way to grow is like not starting another business similar to it, because it takes time to grow it. So sometimes competitors will try to grow by acquisition. So that could be like a strategic buy for somebody.
Yeah.
Other times it could be like a group of investors who think this is a good return on investment, and they might sometimes form a fund, so to speak, and we call them, private equity groups.
Yeah.
Where these private equity groups are really, an alternative investors who are not investing in public markets like the public stocks, bonds. They're looking for something a little bit more riskier, perhaps.
Yeah.
And they can form a consortium and put some funds together, and then look out for some businesses that might be good targets for them to make return on investment.
Yeah.
But each buyer has their own way of how they continue business, right? Like if it's a competitor that's buying, well, they might be looking to see, okay, well, I know the business, I'm in this business, so they can literally take over very quickly.
Yeah, and just integrate their operations.
Yeah, they can integrate, and integration happens over time.
Yeah,
they might remove the existing staff and try to look for efficiencies.
Yeah,
that happens a lot in accounting firms too.
Yeah,
right? Some of the accountants get acquired by bigger accounting firms, and then they integrate them in. So that's like a good example. But it really depends on what the seller is interested in. If they want a quick sell, then a competition acquiring you is a better fit sometimes, because it doesn't take long for a transition to happen for someone to take over the operations. Generally. Yeah,
generally, because I feel like if you're going to do a succession plan within the family or within a key employee, there's a period of time where you're transferring knowledge, and you may stay back, right?
Yeah.
During that transfer.
Yeah.
Which can take a lot of time to fully transition out.
Yeah.
And also in getting paid, right?
Yeah.
Like sometimes you have these deals within the family or within key employees where you're getting paid over a longer period of time.
Yeah.
Versus if you're selling to a competitor that might have the capital to just buy you out right away.
Yeah, yeah. And, I find that the founder who's selling out, they sometimes have, if somebody really wants to retire, then they're looking for a buyer who will completely take over, less painful, transition is quick.
Yeah.
And they can be out. Or other times when they're looking to sell, it's like they're looking for growth. They want to scale their business by offering their business to, let's say, a private equity firm who will want you to stay in, but allows you to cash out some of your equity now. And then you're not really retiring, but you become their, a manager of the company now the private equity firm owns. So like you don't really get out or transition out that fast. They typically
want to keep you on.
They want to keep you on. Yeah. Like private equity firms, when they're acquiring you, right, they want the businesses to run as they were running because they're more interested in return on investment,
Yeah.
generally speaking, and then they'll want the existing owner to stay on and run the business for them because they don't know anything about the business sometimes. They might be like, they're not competitors, so they don't have the knowledge of the industry sometimes.
Yeah.
So it's a different ball game, and then you have to be strategic as to what is aligning with me as a seller or a founder, and what are my intentions.
Yeah, all to say that even figuring this out, when you start the process, you might not be thinking about all this, but as you're entertaining different offers, these things come up.
You learn a lot.
You learn a lot about what you really want,
Yeah.
which takes time.
It takes time to what you really want, what you're okay to give up. Sometimes founders are tough to, when there's other owners get into the, ownership of the company, now they're not the lone wolf,
Yeah.
right? Now they
don't call the
don't have the
shots.
same autonomy anymore.
Mm-hmm.
Yeah, like you said, they don't call the shots anymore, right?
Yeah.
Or generally, so
Generally, yeah.
so they have to be okay with the fact that they, if they're no longer the owners, and
They may not want to stay at all.
Yeah,
They
yeah.
want maybe a more clean, smooth transition, just to be completely out.
yeah, so like the buyers can depend. You could look for a particular type of buyer which is more suitable with your intention.
Yeah, I think it's important to do that. I
Yeah.
think that's something that everyone should think about
Yeah.
before they're even exiting or
Yeah.
entertaining an exit. It's a
Yeah.
lot of things to think about up front.
Yeah.
Okay, so let's say we found a buyer,
Mm.
right? How does that look? If you could maybe talk about what you've seen, what the process looks like.
Generally, very commonly the buyers are usually represented by a broker. Usually a broker, there are all sorts of buyers in the market, and they have, they will engage somebody to look for businesses that are selling.
Yeah.
And they help meet
Buyers
the
and
buyers
sellers.
and seller, and then they're going to facilitate the transaction and be helpful along the way to make a smooth transaction. So, anytime a buyer has found a particular prospect, buyer generally wants to start negotiating or giving them an offer.
Yeah.
If it's an unsolicited offer, meaning seller wasn't selling, they just thought this particular person might sell, there's a whole different process of like giving them an offer, seeing what their reaction is, whether or not they're even looking to sell. That's a different thing.
Yeah.
And then if they're serious about it, that can sometimes trigger people from, start even thinking about it. When an unsolicited offer comes and they're like, oh, this is too good to be true. Maybe seller becomes serious about thinking along those lines.
Because they may not even be aware that there was this market, or I'm going to get paid X amount.
Yeah.
And now they're like, oh, this looks nice.
Yeah, this looks nice. Well, I'm about to exit now.
Yeah.
right?
Yeah.
But if it's a buyer, if it's a seller that's actually looking for a buyer, then it's a different way of approaching it, because they may have engaged their own broker
Yeah.
who takes them to market and almost like creates a bidding environment where they put out a sales pitch deck, and that marketing material that they put together, talks about all their, what business it is, what the financial metrics looks like, how much money does it make, how many employees does it have, what type of industry they're in,
Yeah.
what type of growth prospect this industry is experiencing, and how does it compare this particular business on average? Like, is it performing better than industry average? Is it doing, so it markets them in a positive way.
Yeah.
And then it also says, well, the buyer's looking for either a purchase price of X. So if you're interested, you have to offer that, and then take it from there, right? Then the buyer knows, okay, if I need to be considered, they're looking. It's like buying a house.
It is. Yeah.
You list your house on MLS.
It's a bit easy. It's a bit more complex than buying a home, but
Yes.
but yeah, you're thinking about it in the same way.
Yeah, like the buyer has put out an offer that if somebody were to give me that offer, I will sell.
Yeah.
And then the buyer comes through with the same offer, then I think negotiations are not that.
Yeah. I think
Much.
even prior to that, sometimes there's conversations that take place where you see if this is a good fit, like you said, right?
I think that happens in the due diligence
Yeah.
piece, right? Like they
Yeah.
have to, once they start to even consider that we're aligned on the purchase price or the economics, then they can start to see, well, does it really do what they're saying?
Yeah.
does the financials, I mean, well, there's a whole due diligence process we can talk about,
Yeah.
but it really is a little bit of courting of, depending on who's more interested. And then there's negotiations generally do happen if the purchase price is not what they're willing to pay.
Yeah.
And then it's also like how many others are interested, right? So they might have a bidding rounds where like, okay, you put your offer and then they'll pick the best.
Oh yeah, they're gonna pick the best based on various things, purchase price being one of them.
Yeah.
But yeah, if there's multiple offers being entertained, then
Yeah. And offers themselves also can vary differently, right? It may not be just the fact that it's what they're willing to pay.
yeah.
Sometimes they bring in other variables that become equally important. Not just the purchase price, but sometimes they say, well, you need to stay on in the business for X amount of years or months or weeks. And then so that could be a deal breaker for somebody. It's like if somebody's looking for a quick exit, they may not want that. They may look for a buyer who is willing to just buy, give them a very short transition and walk away. These things can play out. Sometimes the offers could be along the lines of, I'm not, it's about like that they're willing to accept the purchase price and how and when they're being paid.
Yeah, so the payment, when are they being paid?
When
Because
are they
there's
being paid?
multiple different ways to structure that.
Yeah, like
based on earnings.
I think we saw a deal just not too long ago, right? Like where if you're getting all cash on closing, great. But how many times do we see that?
Not often at all.
No. They'll say, okay, we'll pay you 5% as a deposit. We'll give you maybe 50% on closing, and then rest could be like
overtime based on different contingent expectations. Like it could be different contingencies, different earnings that you have to meet in order to get paid.
Yeah.
So I don't think a lot of sellers
sometimes
think about that.
financing is a thing too, right? Like the buyer has put out a bid, but like they put a financing condition.
Yeah.
And then how long that financing condition takes, that could string someone along for a long time. Like we've seen deals where, we worked on a deal where, a CEO wanted to buy out the company and had a very promising private equity firm who wanted to back them.
Yeah.
And I think the deal went on for 1 year before they finally the buyer figured out that this CEO will not be able to arrange for financing, and then the deal fell apart.
Through. Yeah.
But we were so far along in doing all kinds of things, but just that the money was just never came through.
Yeah.
Right. So
that was unfortunate.
That's a very unfortunate event, right?
But it can happen.
Yeah. And especially if it's happening from within, and the owner really wants to really trust that CEO. That look, I trust this person. Obviously, they're running my business. They know a lot about my business. They're the executive of my team. But if the money never comes through, then you may have let go of other offers in the meantime while you're waiting for this one to come through.
Yeah.
So
definitely.
I think financing is such a huge condition in any market that if the buyer has the money, I think, and you're looking for a quick close, they may not be offering you as much. Maybe they're 10% lower
but you
than
might
others.
take it because you want the cash and just to be done with it and exit and retire if that's
it's
if
such
that's
a
what you want.
psychological game, right?
Yeah.
And that's only at the beginning. Like this is all just the beginning
Yeah.
of the process of you getting to a place where you can then say, okay, now I have a buyer. I think we agree on the terms of what are they buying, when are they buying, when are they going to pay me, and what is my involvement after they're bought out.
Yeah.
Right? And if all these variables work out for you, then I think you have a good starting point to even have logistical point of putting an offer that gets signed.
Yeah.
Maybe you can walk me through like the letter of intent and other things that you see.
Yeah. So
after that,
once we've gotten to that point, and some negotiations have taken place, then you have that initial letter of intent, which is just an intention to purchase.
Yeah, it's a non-binding.
It's a non-binding contract just to show that you're interested in buying, and you can start your due diligence. And I think at that point is when, after all this has happened, that clients reach out and say, hey, we're looking to sell in,
and that's
in 30 days, sometimes in 30 days. And I think that's when we're notified, when, you know, there is that letter of intent.
Yeah. Maybe let's break it down a little bit more in terms of what is a letter of intent? What is it meant to do? What type of things does it usually mention? And then we can talk about more like, you know, practicalities of like when we usually get in.
Yeah.
Right?
Yeah, typically what I've seen is like it lists out who's purchasing and who's selling, right?
Yeah.
And then
what are they buying?
What are they buying? Is it shares? Is it assets?
Yeah.
You know, is it a combination of the two? And then what is the purchase price?
Yes.
Right? And how are they getting paid?
Yes. When,
right?
how.
When, how, based on what?
Yeah.
It kind of lays out the deal terms at a very high level.
Yeah.
And it's signed by both parties.
Yeah. Yeah. And I think it's a non-binding agreement, not definitive agreement, not comprehensive, could be just a couple of pages.
You can back out.
Yeah, you can back out. You basically want to list out the things you mentioned, but also make it clear that you have an exclusive period. You're not going to be looking for other buyers during this time.
Yeah.
Sometimes you pay down a deposit, maybe 5%, and you say, okay, for next 90 days, you're not going to be looking for any other buyers, and we're going to be exclusively dealing with each other in good faith that this deal is going to close. And in the time that they are going to be making this deal, definitive agreements through lawyers, accountants, etc., they generally do due diligence. So they, you know, make it clear that the expectation is that they will be sharing information in a confidential manner, that, you know, all information they need to make a decision related to the company, making sure the company in itself, what the seller is saying in its marketing material, let's say it does X amount of revenue, X amount of income, they try to verify that.
Yeah.
And if they're buying shares of the company, you know, they want to do additional due diligence from a legal perspective, tax perspective, to find if there's any hidden liabilities. Because as you
because when you're purchasing the company, then you're buying all the hidden liabilities with it as well.
It may not be on the balance sheet, right?
That may not
Any
be on the
risks.
balance sheet. So the risk is much higher when, from a buyer's perspective, when they're buying the shares of the company versus just like X asset.
If there's any like you know, things that we see that they're worried about is like, well, did you have you been deducting expenses for tax purposes that you should not have? Or taken aggressive positions for tax purposes? It may not, CRA might not have caught on to that, but they may come back to you 5 years later or 3 years later, and then the buyer, who is the current owner, is on the hook for it.
Yeah.
So they try to do a diligence process to make sure that they identify at least any red flags that are glaringly around, and mark them up and maybe become part of the
negotiations,
because negotiation really doesn't end.
No.
By the time you get the letter of intent, things can come up during the process of buyout that now they're discussing other things. And we've seen, you know, negotiation continuing.
Yeah, and I think there's due diligence
too.
happening on the financial side too, to, you know, look at more detail into the financials to see what are you actually buying, and is it actually as you had it in your slide deck? Is the company running in that manner, you know?
Yeah.
And negotiations definitely can start. It still happens afterwards as well once you sign the letter of intent.
Yeah, absolutely. I mean, not every buyer does this, but, you know, buyer definitely wants to examine the financial statements. They want to see the company making the revenue that it does, the existence of assets that the company says it has on the balance sheet, the expenses that they have, you know, that make sense in the businesses that they are in, and they look at all kinds of ratios and making sure that the business is in fact profitable, and the numbers are not manipulated to present it in a way that tells you the wrong story.
Yeah.
Right? They also look at what level of financial statements they've gotten in the past.
Yeah.
Is it audited financial statements, reviewed financial statements, or is it like some bookkeeper internal financial statements that may not be accurate and what they're relying on is okay or not,
Yeah.
right? So there's so much that you rely on the data.
Yeah,
And
definitely. There's a lot that you rely
Yeah.
on for sure.
it really depends on the buyer sophistication too, right? Sometimes we've seen deals like not much happens in terms of diligence and they're like, let's go and buy
Yeah,
it.
definitely. Yeah.
Whereas other goes like overkill, right? Like they overanalyze every little thing,
Mhm.
and people get exhausted during the deal.
Exactly. Yeah, the seller is getting exhausted, right? Because they're
Yeah.
just hoping to sign and close.
Yeah,
But they need to also understand that
Yeah.
the buyer is going to do their due diligence, which is
Yeah.
going to take time. A lot of questions are going to be asked,
yeah,
and a lot of information needs to be gathered during
Yeah.
that time.
yeah,
And typically, it's not like the buyer and seller are working together, right? There's a team that's working, sharing that
Yeah.
information, and you're going through different people to get to the end,
yeah,
right? Which takes time.
Yes.
So it's not as simple as I'm going to sign the letter of intent and we're going to close tomorrow, right? Because what happens, as we both know, accountants, us tax advisors are hired, right?
Yeah.
Representing
yeah,
either like representing the buyer or the seller, and there's structuring needs that come up in
yeah,
order to save tax on
Yeah.
the sale.
yeah.
And
you
that
bring
can
out a
take-
really good point, like in terms of what happens. Like, I mean, maybe we'll start with also the diligence process, right? Like we were talking about.
Yeah,
I mean, logistically, the sellers get inundated with list of information or request
yeah,
if they're buying, especially if they're buying and they're selling shares of a company.
yeah. They're
You
looking
know.
at the tax returns, the financial statements. Maybe they're going back
Corporate
3
minute
years,
books.
corporate minute books,
Yeah.
which you may
yeah.
or may not have, or you have
Contracts,
to
employment
get.
agreements.
Yeah,
Like it's.
and all at the same time you're running your business.
Yeah, and you can't tell the people you're working in
Yeah.
the company that they're going through all this process.
So you
it's
can't
like
just
again, being
delegate.
lonely again, right?
Yeah, you can't delegate it.
Yeah,
It's
yeah.
you doing it.
So, I mean, we've seen our list when we are representing buyer, we do our diligence from a tax perspective. We often send like a 40, 50 questions to begin with, not pages.
Yes,
Um,
of requests.
yeah, I mean, a lot of it is historical data, but like maybe from a tax diligence perspective, right? Like we typically ask for, give us all the accounting data, all the tax filings, income tax, payroll filings, HST filings for the last 2-3 years at minimum. And usually they get examined for, are they filing things properly? Are they claiming things properly? Is the financial data clean? Or is it messy? Or like, does it stuff tie out? Like, do financial statements and the trial balance and all the other accounting data, cleanly flows up to the tax records? And has CRA ever started an investigation? Are there any ongoing audits? I mean, there's so much that happens
Yeah.
in the background, and that's only tax.
Yeah, that's only tax. That's
Right.
not even the financial due diligence, if there is any. Yeah.
Yeah, and there's a lot of pressure. I mean, we see those lists come to us when we're representing sellers,
Yeah.
and we have to continue to work through their questions and answering their questions and whatnot. But definitely could be an exhausting process for somebody. So ultimately, the buyer has to be prepared, and the seller has to be prepared to go through this mental marathon
Yeah.
of this process itself.
Yeah. At least be aware, right? And I think that's the point, for us to let them know that this is not going to close as quickly as you imagine. There's a lot
Yeah.
that needs to get done in between. And it's
Yeah.
important to get this done as well, right?
Yeah, yeah. I mean, some things come up during the diligence, and often if we do find issues on tax, let's say you do uncover an issue that sometimes sometimes even sellers are not aware of it.
Yeah.
It's not like they're doing it on purpose to maybe create a tax issue and whatnot, but it does get discovered sometimes or reveals itself because someone is looking so closely, maybe sometimes forensically.
Yeah.
And we've seen, depending on the severity of the issue that's been uncovered, in the buy-sell agreement, sometimes you put in a reduction of purchase price
Yeah.
or some long horizons of a holdback
Yeah.
on the purchase price is held back until that issue gets resolved. And if it takes 3 years to resolve that issue, meaning like CRA may not come back for 3 years, then that money is released, right? So
Yeah.
these things can always be ingredients that are in the making, and you don't find out about them until the diligence period is over.
Mm-hmm.
So that's like your diligence piece.
Yeah.
Maybe like talk to me about like how, you know, in tandem with all this diligence process that we just spoke about, like what goes on in respect of the definitive agreements, like buy-sell agreements being drafted by the lawyers and reviewed and all that.
Yeah, I feel like there's multiple reiterations of the agreement that I have seen, right?
Yeah.
We start with an agreement,
Yeah.
and then as a tax advisor, we're looking to review that agreement from a tax perspective.
I guess who starts the agreement? Is it the buyer or the seller? Who's lawyer?
The buyer?
We always have to ask that question, right? Because we don't know who has it. Like
I don't know.
and there's no
Yeah.
particular template to this.
Yeah.
Sometimes the buyer's lawyer will take the first stab at it. They'll prepare a first copy of the, an agreement. And these agreements are very massive.
Yeah, they're
sometimes,
very
right?
lengthy. Yeah.
Very lengthy, like could be hundreds of pages, like at least maybe 100 or 200 pages, depending on how big the deal is sometimes and what the complexity is. And then it goes through your various people are reviewing it from their perspectives, right?
Yeah.
Like there's a legal review.
Yeah, there's a legal review, there's a tax review. That's where we've been involved,
Yeah.
reviewing it and providing our comments from a tax perspective to
Yeah.
ensure that it's aligned with what we need it to be and aligned with what the deal actually is supposed to
represent.
right? When there's multiple negotiations,
Yeah.
if things get missed, we have to ensure that it actually reflects the intention of the buyer and the seller, right?
Yeah.
And then if we're representing one side, then we're ensuring that it's written in a way that reflects the structure that we
Yeah.
have in place
Yeah.
when there is a sale, right? Is it
Yeah.
an individual selling? Is it a corporation selling? What is being sold,
Yeah.
right?
Well, oftentimes, like when we are looking from reviewing an agreement from tax perspective, depending on which side we're representing, we have different ways of giving our comments, right?
Yeah.
As a buyer, we want the seller to have as much reps and warranties and like promises that
Yeah.
they will be, to the point like they're over promising sometimes, like what they're saying is accurate, what information they're giving is complete, and all the things that they should have done in the past, like they've actually done them, and like we take so many reps and warranties for that. So if any of them turn out to be untrue, the buyer can go and like make a claim against the seller that they misrepresented them when they were doing the deal, if something doesn't turn out to be true. But as a seller's advisor, you're trying to do exactly the opposite.
The opposite, yeah.
What's transpired? We filed everything that we know is timely, accurate, etc., in the good faith. So you always have to like look out for how the agreements are drafted, who drafted it for the first time. Like it was a buy side, sell side, and there could be different flavors of how the language is written in, and you have to give and take,
give feedback and give feedback depending on who you're representing.
Yeah. And oftentimes, depending on how much time parties have to close the deal, these things will continue to be an iterative process.
Oh yeah,
right?
there's multiple comments that go back and forth, and then you're reviewing the agreement once the changes have been made to ensure it aligns with your original comments.
Yeah.
And then there could be multiple versions of the share purchase agreement or asset purchase agreement, depending on, Okay, Sunny. So we've spoken a lot about the buyer side and what they may be doing during this process with all their due diligence. What is happening in the background from the seller's perspective? What are their objectives, right? And how are they maybe looking at their structure, if they're looking at their structure from a tax perspective? Yeah,
typically, right? Like, so far, all the energy has been spent by the seller trying to find the right type of deal, right type of buyer. And now they're like so busy and like satisfying them to make sure that they now come through with the deal, right? But oftentimes the accountant, or hopefully they have people in their team to help them understand that, look, your deal doesn't just stop from getting a deal. You want to make sure you retain most amount of purchase price and not lose a lot of it in tax.
Yeah.
Although that process should have started long time ago, but you see a variety of different scenarios where the seller has done no planning, they're not prepared to sell. And we see a variety of different scenarios play out, So I can speak about a couple of scenarios. Like one was not too long ago, it was a lab business, and in that business per se, they hadn't previously done any planning to position themselves for a sale. And, and I'm going to give another example that contrasts this particular scenario, but to set the stage is that you've got one owner that owns one corporation. The corporation has all the business in it. And the buyer, the seller didn't know that how much they will get after taxes. Because remember, like always, that whenever you're selling something, it's going to create an economic gain or a capital gain for tax purposes. And then there's going to be tax event, like you're going to pay tax on that deal. Well, how much is that tax? Sometimes the sellers doesn't understand like what is the outcome of this.
Yeah.
So oftentimes they'll ask the accountant like, hey, can you look at this deal and like tell me what I will get after taxes? Mm-hmm. And the accountant
because so far at this point they're throwing numbers in the air of what the proceeds are going to be.
If you lose like a third or a fourth or even into taxes,
they might be thinking, oh, we're gonna, this is a $30 million deal, we're walking away with $30 million. That's not how it works.
That's not the case, yeah.
It's a tax event, so
it's a tax event, right? So you might be losing 30-40% in taxes sometimes if you're not prepared properly.
Yeah.
So what I would always recommend, or what my process has been, is that when we get engaged, we say, give us depending on when we came into the deal, if it's a letter of intent's already been signed, we know what the deal is, then we basically, on Excel, we will model out different scenarios. Well, if you do nothing, just sell as is, you do no planning, how much after-tax dollars will be in your pocket afterwards. Mm-hmm. So that's like a base case, do nothing scenario. Mm-hmm. Then any good tax planner will look at alternative scenarios. Like, can we restructure this deal in a way that will change the outcome of taxes? Either it will reduce taxes or defer taxes, meaning taxes could be pushed down into the future, so you get to keep the money for a longer period of time with yourselves. And look at different outcomes.
Yeah.
And then depending on the outcome that person finds, that's the outcome you pitch it to the client, and you say, hey, you can do nothing, you get X, you do Y, you save X amount of tax. Maybe the tax rate drops from like what would have been 30% down to like 20% or 15% even sometimes. I'm just making up these numbers, but that can happen. Mm-hmm. The question is like, how does it happen?
Yeah.
So that's the interesting part. Like, some things that it's not a magic that someone creates.
It's not a magic spell, no.
It's not a magic spell that the tax planner just suddenly reduces the tax rate for you.
Yeah, there's multiple steps to get to that point.
There's multiple steps, and it depends on like what can be done, right?
Yeah.
Like very commonly, each business owner generally knows this, but they find out about this, especially if they're selling, is that there's something called a lifetime capital gain exemption. Each individual who's resident in Canada has currently the rate, it's about $1.25 million of lifetime capital gain exemption. This exemption is extremely limited to certain circumstances and certain types of.
I do want to say not everyone knows about it.
Yeah.
That's important to say,
I
because
agree.
My dad's an entrepreneur, as you know, and he did not know about it at all.
Yeah.
He's also someone that doesn't think about exit and doesn't want to think about that at all because his business is his baby. But, not everyone's aware that you have this exemption. Yeah.
So maybe let's unpack that also.
Sure.
Like, what is a lifetime capital gain exemption? Who gets it? And how is it all ties back into any deal per se, right?
Yeah. So as Canadian residents, right, we all have this lifetime capital gain exemption available to us to use. If you log into CRA, you'll see that
And
There's
how much is it worth? Like, I mean,
it's
one lifetime
yeah,
capital
so
gain
it's
exemption will
around, so in
save
tax it'll save you around like $370,000.
it's like 27% in Ontario. I mean,
20
depending on the province
Yeah,
you're in,
27% of your
1.25 million.
yeah, that will be the tax.
So call it
that
like,
you could
let's round
save.
it to, let's say $340,000
Yeah,
roughly
sure.
per person.
Yeah, per person.
Like, you're not physically writing the check for this amount. It's totally
Yes,
exempt.
it's totally exempt,
Yeah.
right? And each individual as a Canadian resident has access to this.
Yeah.
And there are certain conditions that have to be met. One being that you're selling shares of a qualified small business corporation, right?
Right.
And what that means, there are certain conditions. It's defined in the Act. They have to be shares of Canadian-controlled private corporations, so public companies. This doesn't apply to them.
And what can be the makeup of the company? Like, company can obviously operate any type of business. So what's the makeup of this company that makes it qualified?
Yeah, so it can be any operating company, but it can't be just a passive company. You can't
Like-
just hold cash and stock.
Like investments. Investments won't qualify.
It won't qualify. You
Yeah.
can't just, sell your shares of your holding company that has all your investments and try to claim this lifetime
Yeah.
capital gain exemption.
Yeah.
You might not even find a buyer in that
So what the
perspective.
government is trying to
But
do
they're-
is that policy-wise is basically saying that, look, we get that as a founder, you've done a lot in terms of
Yeah.
making sure you have a business, you've
Yeah.
contributed to the economy. We want to give you a
This
tax
incentive,
to walk away with at least $1.25 million tax-free, and then anything over and above, you're going to be paying taxes as regular.
Yeah.
Let's say 27% capital gains, etc.
Yeah, but the requirements are, at a very high level speaking, you have to hold your shares for at least 2 years.
So if I started a company and it has running a business, I need to just own the shares for 24 months.
For
If I ran
24
the
months.
business for 24 months, 2 years,
Yeah.
that
Yeah.
will get me there.
Yeah, that will get you there. And then
That's easy.
Yeah, that's easy. And then for the past 2 years while you're running your business.
So from the date of the selling date, looking back 24 months.
Looking back 24
Yeah.
months, we want to look at your balance sheet. When we're hired to see if these conditions are met, we're looking at your balance sheet and we want to see that more than 50% of your assets that you have on your balance sheet relate to an active business. They're being used in your active business, carried out in Canada.
So let's use an example. So very
Yeah.
commonly we see is that, companies pay less corporate tax
Mm-hmm.
generally on an active business. The rate
Yeah.
can be as low as 12% in Ontario,
Yeah.
or as high as 26.5%, which contrasting to personal tax rate, which could be up to 54%. So
Yeah.
people usually retain their after-tax profits in the company, after corporate tax profits in the
Yeah,
company, and they accumulate that.
Yeah, in the beginning, like we were talking, like entrepreneurs, they're in the growth stage. They don't know if the business is going to do well, not do well, but they get to a point where they are doing really well, and then
And they have some savings. Some
they have
nest eggs.
savings, some investments, and, usually, not always, but they might be just investing that within their same active corporation.
So let's say if you can picture a corporation with 2 buckets of assets,
Yeah.
investments and your business.
Yeah.
Your company is running 2 businesses at the same time. One is like investment piece and the other is your
Yeah.
actual
One's
business.
more of your passive investments,
Yeah.
and then one's your active business. Yeah.
So if my active business, to get this qualified small business corporation test, if my active business is always more than 50% in value compared to other assets like investment, then
you meet that one
24.
condition.
The second condition.
The second condition,
Right.
generally speaking, over the past 24 months, you want to meet that 50% test. So
But
your
more than
active is more than 50% relate to your active assets employed
Right.
in your business.
So if you have excess cash, GICs, public stock, bonds.
Those are considered bad assets for this test.
for this test. Okay.
Yeah.
So I got to make sure that throughout the 24 months, your corporation value, more than 50% is value is coming from the
they are looking at the
corporation
market value,
active assets.
the
Market value.
the market value of these
Right,
assets. Yeah,
right.
they're not looking at the cost basis.
So, from a practical standpoint, how do you make sure that we meet that test?
Well, I wanted to
when
say
you said
that-
throughout,
Throughout the
like
24
every
months.
minute of the day, every second of the day for the last 2 years. Like, how do we practically get around that? Like, how often, like when you say look at the balance sheet, right?
Yeah.
How many balance sheets are you looking at?
So typically we look at the monthly balance sheets. Yeah, we go and get the 24 months of balance sheets, and we're testing for that 50% test at that
So you
point
need to
in
have like
time.
a good amount of data, good bookkeeping records.
You
in
need good
order to do that.
bookkeeping records. You need to ensure that they're representative of, you know, that time, right, for that month. But it's the past 24 months.
Right.
Yeah.
Okay. And then, yeah, go on. You had a third test also.
Yeah, there's also a third condition as well, and that condition is that 90%, at the time that you're going to sell, 90% of your assets have to meet that active test. So you only, and you know, if you're even at 11%, you know, that could put you offside. So
your excess cash or investments have to be less than 9%.
Less than
the
9%.
Active business assets needs to be more than 90%.
yeah,
Okay. So, if you meet all these conditions, then whoever is the shareholder in the company gets to use their lifetime capital gain exemption.
if they're selling the shares of the corporation.
If,
Yeah.
if they're selling the company themselves,
This company
an
themselves.
individual is selling
And
it,
an individual. So
Right.
you can't have a corporation
be the shareholder.
be the shareholder. It has
Got
to be an individual selling the shares of the corporation, and you have to meet those conditions.
So, I mean, let's tie it back then, right? Like, oftentimes, then we are looking at this lifetime capital gain exemption. You want to do this test, make sure we meet it. Oftentimes, if we do meet the 50% test, then we look to see, okay, how do we get to 90%
yeah,
test, right?
yeah,
So that's what requires the, some sort of restructuring, because you need to now remove all the investments out of the company.
yeah.
And you
There's
can
definitely things like you
Yeah.
can do in order to meet that 90% test.
So, I mean, what would be the most common or most easier way to take out the excess cash or investments or bad assets, as you call them, is to just distribute taxable income to yourself as like a dividend.
yeah.
But then you'll face like 50% tax on
If
that
you've been
sometimes.
like saving a lot of money and generating
Right.
wealth over time in your investments, that could be a significant amount that you're pulling out,
Yeah,
right? And then you
yeah.
can be losing
the
40 to
tax.
50% to taxes.
Right. So like from a tax planning exercise, then your tax planner will see, okay, do you meet this lifetime capital gain exemption? If you don't meet it currently, then if these investments are going to cost a lot of tax to begin with in order to pull them out, then you can do a reorganization. You can do a reorganization whereby you can move certain assets from the company that is being sold to a new corporation and possibly do it on a tax deferred basis without paying any taxes.
Yeah.
You can move it to a new company, and there are ways to move non-business assets or investment assets from the company you're selling potentially to another corporation, and that is not being sold, and that can be done on a tax-free basis or tax-deferred basis.
Yeah.
And this way now your company that you are selling now qualifies for lifetime capital gain exemption purposes. It becomes the QSBC, as you said it.
Yeah.
And then you can get your exemption.
You can get your exemption,
Yeah.
which could save you around $340,000 in tax.
Yeah. So
that you get to keep and not pay the
right.
government.
So we want to have more people owning the shares in the family.
We do, but before I just want to finish,
Yeah.
I want to say one more thing. We do that for one, to qualify, but
Yeah.
also because a buyer is not going to want to buy a corporation with
these
all
investments in
your
it.
investments.
Yeah, that's a good point.
Right?
Yeah.
So-
Like, I mean, if I'm a buyer, I'm not about to buy their investments because I have to
No,
pay for them.
You're going to have to pay for them. Yeah.
Yeah, so that's a good point. Like a lot of times people forget that, they're only interested in buying a business and not anything else.
Yeah. And what if, we were talking about one of the clients that had a life insurance policy in the
Yes,
corporation.
yes.
Yeah.
Big problem. Like
Yeah.
life insurance is one thing that sometimes, in this particular instance, they had taken a life insurance 20 years ago. It was all paid up,
Yeah.
meaning you don't pay the premiums anymore. It's permanent life insurance. But it got put into this operating company, which is being sold.
Yeah.
And life insurance is one asset that it cannot be moved without paying taxes.
Yeah.
And this is one asset that will you have to pay taxes on attracts very high tax rate and often results in double taxation sometimes. So not a very pretty outcome, but sometimes it's necessary to even get the deal done, especially if the insurance has already been paid up and you just got to move it out. So yeah, you're right. Like, it's so many little things that come into play when you're trying to execute on a deal. It's not as simple as like, selling a house, like we were comparing it earlier.
Yeah, because, when you are trying to meet the test, you want to make sure where you can, you're saving tax.
Yeah.
Right? Because each transaction is a taxable event, unless, you're taking the steps to see if you can get it tax deferred.
Maybe like this example that I said, in this particular example, we had an example where like there was only one shareholder who had their lifetime capital gain exemption, so we could only use one exemption.
Yeah.
But it's often always better to have other family members directly or indirectly as shareholders.
Yeah.
So that you can multiply their exemption, use everybody's exemption.
Yeah, because I think often not everyone's going to use their exemption in their lifetime, right? Not everyone
have a business.
Not everyone has a business.
Sellable businesses on top of that.
Sellable business. Not everyone's going to want to start a business. So there's a lot of unused lifetime capital gain exemptions, right? And I think within your family, you have, depending on the number in your family, often we will see husband, wife, kids, maybe parents. You can be looking at multiple exemptions, and each individual has $1.25 million available, which is around $340K in taxes.
Yeah, like maybe speak to an example we did for Sam.
Yeah.
What we did several years ago to put him on a path.
Yeah. So Sam came to us early. It wasn't during the time that he was looking to exit right away, but he knew in his mind that he would exit one day. That's the perfect time to come to us.
Yeah.
Because like we were saying, there's so much going on during the time when you're in negotiations, looking at share purchase agreements, finding a buyer, that if you have your structure in place, it makes it a lot more smoother, right? So he came to us early, and he was meeting multiple different objectives. One being, we're looking at, if he does exit, can we multiply the exemption?
Use exemption for all of his family members.
So we did implement that for him by adding a family trust.
Yeah.
To own the growth from that point on. So Sam had accumulated a value by owning the shares of his corporation up until that point, and then we passed the growth from that point on to the family trust.
So maybe let's talk about that. Like the process we undertook was something called an estate freeze.
Yeah.
And it's just more of a tax jargon to say that Sam, who owned the company and that had the business, a great potential of sale, like he could sell and get a purchase price. So we took a valuation of the company, of its business at that point. And you know what? Like we took it, this process happened when it was COVID.
Yeah.
Around 2020, 2021, which meant that at that time the businesses were like all doing bad. Mm-hmm. The values had dropped. There were forced closures, and the businesses were like just on life support by the government by giving them subsidies. And at that point in time, the value of his business also had dropped significantly because there was real uncertainty about what will happen in the world. And it just so happened that we were having those conversations. We said, well, it's a good time for you to now carry out this estate freeze. And we took a valuation of the company, which was very low at that point because, hey, like no one's about to pay him what his usual price would have been if he were to go and sell.
With all that uncertainty.
And got a very low valuation at that point, which was independently done. Mm-hmm. And then through the course of an estate freeze, we gave him fixed value preferred shares to say, if let's say your company is worth $1 million today based on the valuation, we give you shares worth $1 million and they're fixed, they do not grow. And then all the future growth will now go to the new shareholder, which can be added in on a tax-free basis or tax-deferred basis. There's no buy-sell happening, but they just get shares. And that shareholder happened to be a family trust.
Yes, in this case, it happened to be a family trust.
Yeah.
Which I will say, for tax purposes, family trusts are seen as individuals.
Yeah.
So they when you do sell from a family trust perspective, there is you can allocate the gain out to the beneficiaries, and they
Right.
can use their lifetime capital gain
So-
exemption.
So if the trust is a shareholder and Sam is a shareholder, and now both of them are selling this company shares, Sam will realize his $1 million of capital gain,
Yeah.
which presumably he's got his exemption of lifetime capital gain exemption. He walks away tax-free for his value. And then in the family trust, there were Sam, Sam's wife, Sam's children, Sam's mom and dad, and then the spouse's mom and dad.
Yeah, I think there were like 7 to 10.
7 or 8 individuals in there, right?
Yeah.
Sam's already used his exemption because he sold his own shares that he owned.
Yeah.
But there were like 7, 8 other exemptions that were available,
that were available. Yeah.
right? So when the trust received the capital gain, the trust has the ability to take the capital gain. I mean, the trustee of the trust who manages the trust, meaning Sam was the trustee.
Yeah.
He looked at the capital gain, and then he split the capital gain or distributed the capital gain to each beneficiary within his family. I mean, the money has, they all realized the capital gains, and then they all had their own lifetime capital gain exemption. All in all, I think there was about $9 to $10 million of capital gain exemptions claimed.
Yeah.
And there was
a lot of tax
tax-free.
saved. Yeah. A tax
Like-
completely tax free. Yeah.
Like on
There's not many
that's $3.4 million, right?
Yeah.
Like $340,000 per person. Let's say 10 individuals.
I feel like there's not many opportunities to get things tax free.
Yeah.
And that's one of the big ones. So
I mean, that was a
adding
huge win.
adding each individual
Yeah.
is saving you so much tax.
But I think we should also not make it so oversimplified, right? Like,
Yeah.
there are CRA rules that says, well, you can't just sham the system by distributing the capital gains
Yeah.
to each person. They really do have to receive the money.
Yep. The cash
And
has
it's
to go to
their
their
money.
account. Yeah.
It's their money. If you're gonna claim the lifetime capital gain exemption for your spouse, it's her money.
Yeah.
If you're gonna give it to your children, it's their money,
It's their money.
right? If you give it to your parents, it's their money. So you wouldn't add you should be okay with the fact that the individuals who are now getting to use their lifetime capital gain exemption, that they will actually get that money, and truly is even though it's tax free, but that's one of the things you have to be okay with.
Yeah. And the money's allocated to their accounts, right?
Yeah.
And you have to be okay with that.
You have to be okay with that and be okay. I mean, overall, the family wins
Yeah.
that they've kept a lot of their
Oftentimes
value
what we
without taxes.
see, the people that are being added are trusted family members. They're
Yeah.
not just strangers that you say, hey, please.
They don't have their accountants, lawyers,
No.
or
No.
other people, friends, and
Yeah.
even siblings sometimes. They just keep it within their nucleus,
Yeah.
right?
Yeah.
So yeah, I mean, that's a great example in contrast to, the lab example that I was talking about, which was just limited to one lifetime capital gain exemption. So they ended up paying more taxes, but there was certainly an opportunity. I mean, that family also had, the husband, the wife, the kids. I mean, in
So
that case,
yeah,
they're
I guess the audience would want to know why in that case were they not able to multiply
because there was
their
only one
exemption?
shareholder. If there's only one shareholder, only one person gets the capital gain.
And why
all of
can't
their-
we introduce more shareholders right before sale?
Good question, right? I mean, we were talking about the valuation piece earlier. When you introduce the other family members into your ownership, their shares have to have value,
Yeah.
right? So, which is why it was so important in Sam's case when we did the valuation. I mean, this is not an exaggerated case, but it's really an
Yeah,
exaggerated
so we should,
scenario.
I don't think we even said that Sam actually ended up selling 2 years later or 3 years later.
Yeah. I mean, that transaction actually transpired 4 or 5 years later.
4 or 5 years later, yeah.
So the shares of the trust in his trust that received had 4 or 5 years time that it owned those shares
to grow in
and
value.
To grow in value, and especially when he took his valuation of the company was during COVID. So the value itself was very understated than its usual value would have been, but that was the time and point in time that the value was. It really did drop. Nobody would buy his practice or his company for the value that it usually would have sold for, because there was so much
Uncertainty.
world uncertainty in terms of where things were going. People were dying and etc., and nobody was thinking about businesses at that point.
Yeah. So that's why it's really important to set up the structure and introduce the family trust well in advance.
I think all business owners should like have a serious look as to how they're structured.
Yeah.
Understand, have a foresight 5 years away, and try to gather information as to what this might look like, and then start taking action. However fast or slow, but if you have knowledge and education, start gathering that information. And tax component is just as important as if you are now going to prepare for a sale by now, hiring that key person who is going to be running the business in your absence, or doing other things to make sure your company is sellable. Right?
Yeah.
Having the tax plan is just as important.
Yeah.
We only had one exemption, and just adding the family members just before the sale would not have done anything, because the shares would not have been worth anything.
They wouldn't be worth anything. You just
Right.
added them. So
You just added them.
Yeah.
Like, what value do they have?
yeah, and I think we should also say that a family trust is one of the ways. You can also add, people directly
Yeah.
into your structure if that makes sense. I think family trusts provide the flexibility because you're not giving up control in that way.
Well, you're not committing that this
And you're
person
not committing.
owns anything,
Exactly. Yeah.
right? Like, I mean, that's a good segue to understand, like, why even consider
A family,
trust,
Mhm.
and just add like your family members, like the spouse, the kids, the parents, etc.
Yeah.
But maybe explain like, why is that a good or bad idea?
Yeah, I feel like it depends, but in a lot of situations, you're giving them direct control and, a commitment to that value, right? The thing is, anything can happen within family dynamics. Anything can change, right? If you're adding parents and children and there's siblings involved, you don't know what the future looks like from a family dynamic situation. So I think a family trust provides a bit more flexibility when you are, giving out this value to the family members that you've added, and you can pick and choose.
Yeah, the way I see it is like, I don't want any interference.
Yeah.
If I am running a business of someone now owning the shares of my company directly, because then now they own it. I cannot take that away once it's given to them. It's really up to them.
Yeah.
And they can interfere in the business, right? So it's a question of control and a question of autonomy.
Yeah.
Right.
And in contrast with the family trust, you're still the sole trustee. So you're going to be, just because the beneficiaries are added, they don't have discretion over that value.
The family trust gives you a great amount of flexibility.
Yeah.
Because you can you can have yourself as a beneficiary, and if you want to unwind anything, you can always take back the shares of the company that's owned by the trust to yourself.
Yeah.
And just unwind the structure, and you haven't really given any shares to anybody, right? So you're back to square one, but great amount of flexibility, and I think that's more people go towards a family trust for many other reasons. I mean, we're not going into every single reason why a family trust could make sense.
Yeah.
But from autonomy, flexibility, and not committing to somebody receiving those shares is like a great pro of why this might work. I mean, the other reasons maybe that's important is like, like you said, you have to be qualified small business corporation. You can't accumulate a lot of investments. So like, maybe speak about like, how does a family trust help you in that sense? Yeah.
So having a family trust helps you in that sense, because if you didn't, and you own the shares of your operating company, and say you have another holding company, right? You're moving assets between the corporations, sister or parent companies.
So like you can have another corporation that's a beneficiary.
Yeah, so with a family trust, what happens is that you're able to have corporate beneficiaries. So it doesn't have to be just individuals. And having a corporate beneficiary allows you to stream value up to the trust, and the trust can then pass it along to the corporate beneficiaries, tax deferred.
So say if I have an operating company, like let's pick Sam's case, right?
Yeah.
What happened was Sam now had a family trust. The family trust also had beneficiary that included a corporation that was owned by Sam. So Sam was a beneficiary, his family was beneficiary as individuals, And then Sam had a corporation that was just investment holding company. That corporation was an investment. That corporation was also a beneficiary. So you're saying that the operating company can pay a dividend.
Can pay a dividend up to the trust, and the trust can then allocate that dividend to that corporation that Sam owns without triggering any tax.
So it's like a flow
as
through.
long as the corporations are connected. But in this case, in Sam's case, they were both Sam's corporations.
Right.
So it's a family trust is more of a flow through entity.
In that sense.
Yeah.
So it ended up giving us an advantage.
Yeah.
That it kept the operating company, free of these surplus, excess cash investments. That's key to meeting the QSBC test, or Qualified Small Business Corporation test, for the 50% and 90% test you talked about. But also, it also removed the assets that the buyer would never want to buy.
Yeah, so you're looking at, before you're selling, you're looking at your, balance sheets on an ongoing basis, right? Because you want to stay on side to access this lifetime capital gain exemption, but you also want to credit proof your business. So I think it's achieving both objectives by having that family trust to flow kind of those funds to that other
every
corporation.
year it's like, the process I usually see as unfold is like every year the accountant prepares their year-end financial statements, tax returns as drafts.
Yeah.
And then you say, okay, well, I have so much surplus sitting in the company, and we don't need this excess cash or that's been sitting in the corporation. Let's just dividend it out. But Sam doesn't need it for his personal lifestyle. His family members don't need it. They don't need that money personally.
Yeah, they want to keep that.
They want to keep it in the company so they can invest it.
Yeah.
But if they invested in the operating company, it would disqualify them over time for the lifetime capital gain exemption. But then if they invested it through their holding company, then it's okay.
Yeah, and I think we should also talk about what if there wasn't a trust and we have just this holding company and we're just, flowing the cash out of the corporation.
Yeah.
What happens there is a related loan or an intercompany loan is created.
Yeah, we see that all the time. Yeah.
Right, we see that all the time. And I think it's important to say that intercompany loan may not be eligible if you're just using those funds to invest. It's not a good asset for that test.
Well, typically, investment opportunities come up throughout the year. Like if you're not going to wait till the year end.
No.
To make the investment decisions.
Mm-hmm.
If you have an opportunity to invest, you're
going to invest.
They're going to invest. Like
you're going to find the cash and move it.
Operating company and move it.
Yeah.
So if you move that cash from operating company to your investment holding company, a sister company, let's say, then it creates a intercompany receivable in operating company, which is going to be considered to be bad asset for your QSBC test.
Yeah.
Because it's seen as just as like an excess cash.
Yeah.
So then that receivable is really trapped in the corporation, but if you had a trust,
but if you had a family trust, you can clear that on a tax deferred basis.
Right.
Yeah.
You can just give that receivable to the holding company as a dividend.
Yeah.
And then clear it.
Yeah.
But it also, I think, adds another value is that it also credit proofs you.
Yeah.
Your corporate. So if some claim comes up in your operating company, your savings or your nest egg is not impacted.
Yeah, and you don't want those intercompany loans, right? When you're trying to credit proof, so.
Right. So in Sam's case, I think it all worked out. He got 10 lifetime capital gain exemptions versus the lab only got 1.
Yeah.
Sam was able to use credit proof the company over time and not be exposed to business risks to his savings and nest eggs. And then buyer never wants to buy a company with investments in it, so he always met that condition also.
Yeah.
Right. That's. I mean, that.
He's
really
our model client.
He's our model client, right? Like it was a winner. Okay, so let's shift gears. I mean, we have spent a lot of time thinking about selling to external buyers, but originally we were also talking about you could sell to your family members, right? Let's say a parent, most commonly, may want to bring in their succession to their child, right? If they're old enough, they're interested, you can coach them, bring them onto the business, and eventually give them that business. Mm-hmm. And what are the tax consequences of the parent now transferring the business to the child, right? Like when I say child, like you're talking about adult grown up
Yes.
person who
Not,
can take over the business, not a
yeah,
minor,
not a baby
not a
taking
baby.
over a business.
Yeah.
CEO.
Yep. Baby CEO. Yeah.
So, just up until recently, I think it was 2021,
Yeah.
selling to your child wasn't treated the same as if selling to a third party or an unrelated person.
Yeah. In what way? Like, I mean, you could always sell and pay the tax.
You could always sell and pay the tax, but you weren't
capital gains tax.
you
yeah.
weren't able to sell and claim your exemption and then get
The lifetime
the lifetime capital gain exemption and get the consideration.
Yeah. That always
upfront.
seemed like very unfair. Like I almost felt like, since capital gains tax came into play in the 1970s to 2021 or so, all this time, any transaction within the family was treated unfairly.
Yeah.
That you're motivated to sell, you have a better tax result because you have all this exemption that we just spoke about so much.
Mm-hmm.
To get the exemptions if you're selling to external buyer, but if you sold within the family, you could not use your exemption, you're saying.
Yeah,
right?
and I think the government feared that there'd be a lot of manipulation, that you're selling using this exemption, lifetime capital gain exemption, and then extracting funds from your company without actually genuinely transferring your business to your child.
Yeah.
But I think in a lot of cases, with a lot of clients that we deal with as well, there is an internal succession that is occurring.
There's a genuine desire that the child would actually take over and not just like manipulate the system to.
And I think that does happen often, right? I think parents would be very proud to have their kids take over, and it's something that they would want for their kids, especially if it's a successful business.
Yeah.
And if the child's been working there, and they want to take over, it was unfortunate that wasn't available to them to do so. Yeah.
Right. I mean, it's a lot of money that if I'm motivated to sell elsewhere, I think the child has no option.
Yeah.
They cannot change the rules. I mean, to equalize somebody to pay, then you'll basically have to equalize them, right? Like to say, hey, sell it to me, I'm a better buyer, I'll take care of your business better. Mm-hmm. But if you sold it to them, you would be disadvantaged because now you have to pay all this tax that could have been, very tax efficient if you sold externally.
Yeah.
So, but from 2021, they've changed the rules, and now
they
allow you to use your exemptions.
Yeah, they've changed the rules.
Finally.
There are certain conditions that have to be met and proven.
Yeah. So let's go through them.
Yeah, sure. So one of the main things that they want to see is there's a genuine transfer of business, and the way they see that. Why are you laughing?
Well, how is someone supposed to say it's genuine? Right? Like, it's such a funny concept. Like, it's a feeling that it's a genuine, or like.
Well, they want to see that
how can someone verify that?
Their verification is to see that you've given up control, and not just voting control that you see on paper. They want to make sure that you're actually
that the
stepping
parent
out.
has relinquished all their reins of the company and the business to the child.
Yeah, and I think they do give a time period, for some of the succession to happen. I think they've acknowledged that it doesn't happen overnight, right? But the whole point of it is to, there's a genuine transfer.
Yeah. I mean, I think there's always going to be some bad actors and people trying to manipulate the system. Yeah. But I think assuming that, vast majority of the people are like genuinely want to do a succession, I think it's a good path to open up.
Yeah.
And now currently, there's been changes and it's an evolution of what the rules have come to be in 2025.
Yeah.
Let's talk about like who can qualify within the family in order to take over the business. Very simply, we've been talking about the parent and their child, right? But really is also
anyone can take over the business, but in order to qualify for the lifetime capital gain exemption and to be treated as if you're selling to an unrelated person, then it could be the children of the parents, the grandchildren, the nephews and nieces, and the grandnephew and nieces.
Yes, okay. But I want to clarify one thing, that it's not that it occurred to me now, is that it's not that you couldn't claim lifetime capital gain exemption in the past within the family.
Yeah.
It just meant that the child had to buy the shares personally from the parent. And that's usually very inefficient because in order to pay the purchase price to the parent, the child had to first pay themselves personal tax after tax money. So they would have to take out money from the company, pay personal tax, and then pay off the parent. So the personal tax always got in the way
Yeah.
for the child in order for them to use their lifetime capital gain exemption. So like
Yeah.
it took a lot longer for the child to come up with the same purchase price.
Yeah, to come up with the funds. And because, sometimes the parents aren't looking to entirely be paid out if it's within the family,
Yeah.
But you're dealing with, the funds are sitting in the corporation to fund their lifestyle.
As a buyer, like if it's a third party buyer, it's much more efficient that you somehow pay for the purchase price without incurring any personal tax. So typically, you form a holding company that typically buys the target company, the corporation you want to buy. And then usually, corporate taxes are paid throughout, but then you'd never incur any personal taxes to pay off the seller, right? And that was a key difference between if you did this type of holding company type of structure, whereby a child formed a holding company, then that holding company purchased the operating company shares from the parent.
Yeah.
Then that was a bad thing. You couldn't claim the lifetime capital gain exemption.
Yeah.
So then now they have actually said that, okay, you can do this transaction. We will allow the parent to claim the lifetime capital gain exemption in the same way as any other buyer would, and they typically would form a holding company that way. And then they would, let me just get back to you now. Like there's two tracks, and then the child is defined to be, like you said it was child. So they're children,
The grandchildren.
their grandchildren, grandnephew, and grand.
Their nephew, nieces, or grandnephew, nieces.
Yeah, nephew, nieces, and grandnephew, nieces.
Yeah.
Yeah. So now that you've defined, okay, it can go from downstream to the next generation that way. Let's explain what are the two paths. There's an immediate path, and then there's a gradual path. So explain the immediate path to me.
Yeah. So the immediate path involves a transition of control, legal control, as well as de facto control is kind of the word that is said in the act.
That you must give up control.
You must give
in
up
reality
control.
And also legally.
In reality and
Yeah.
also
Yeah.
legally.
Yeah.
And then you do have a time frame to give up the management,
Like how to run the business.
how
you
to
can
run the
teach them.
business, to download that information so that the children can take over operationally. Because
How long is that?
that is 36 months.
36 months. Okay, so
Yeah.
within 36 months, you have to completely give up the management. You can't be working in the business and be management. It can't be a person who's like managing the company.
This is how
the
they're
parent.
defining it
Yeah.
being an immediate, genuine transfer.
Right.
Yeah.
Okay. And then what else? The child has to own the shares.
Yes, the child has to own the shares
For how long do they have to?
for
own it?
36 months.
Also
So
36 months.
yeah, so they're not able to just, do this transaction, get access to the corporate funds and, the parent claim the exemption and then just sell the business
Right.
to a third party. Yeah.
So to keep things genuine, they're
Yeah.
saying you can sell it to your, claim the lifetime capital gain exemption, but the parent has to give up an immediate control of the company. The management of the company has to be transitioned within 36 months.
Yeah.
During that 36 months, the child cannot sell the company
Yeah.
to someone else.
Yeah.
And then I think there was one more test that the child has to work in the business for the 36 months.
The child has to be actively involved in actually working in the business
So-
for those 36
right.
months to showcase an immediate transfer.
Right. And I think that's, I mean, seems like these are all the signs of someone who would want to genuinely take on a business.
Yeah.
They will certainly take control of the company right away. They will certainly ask their parents to show me the ropes, how to run the business. That transition can happen within 36 months. It's obvious that they would be active in the company, not just not active.
Yeah.
And then, also the fact that they have to keep the company running for the 3 or 36-month period.
Yeah.
So that's what genuine really means in the immediate path.
And then if this does happen for a client, let's talk about, how does it actually look for them? Typically what I see is that they get to, sell their shares if it qualifies, the parents. They'll use their lifetime capital gain exemption upon that sale, and the child will buy through their holding company, right? And what ends up happening is that there's a promissory note usually owed to the parents, which
the
they
children don't have the money to pay for the purchase price, so the parent is like basically saying,
Yeah.
give me an IOU and you can pay me over time.
Yeah, and you know, the parents have that option to forgive that or gift that to their that promissory note back to their children if they don't need that, or fund their retirement through the corporation funds without
Right.
seeing any personal tax up to that amount.
So let's talk about the gradual transfer. So immediate seems like very quick. You got 3 years to meet all the tests.
Yeah.
Maybe I can cover up the gradual. So gradual can extend from 5 to 10 years. You have the management transition has to happen over 60 months, so 5 years, and the child has to be in control of the company for about 60 months, which is 5 years per se, or the time that the transfer has been completed.
Yeah.
So why would somebody take a gradual path versus an immediate path?
I think it really depends on the family member. Like some individuals that have built this business for many years don't want to stop being involved. I think sometimes it's very difficult for them to, give up all their operational control to their children. Right? But this allows them to still have that 5 to 10 year time period to do that, right? To coach their children and them also feel that, they feel that they're ready to, retire and play golf all day.
Yeah.
Like sometimes they don't want that lifestyle and they still very much want to be involved in the business.
I think this maybe speaks to the reality that not every parent is ready to relinquish their involvement in the businesses that they've carried on for so long.
Yeah.
And some people don't want to retire as fast.
Yeah.
Right. So in my practice, we haven't done much of gradual transitions yet because all the files we've seen, because these rules have only been around for some short period of time, that we haven't seen every single scenario play out yet. But it's interesting that they did open up these 2 tracks to give you flexibility to recognize that there are some realities within the families that some people are not ready to transition right away.
I do think typically if you're ready to give up legal control,
well,
they're at that point that they're okay to give up operational
but
control.
I think they even in the gradual, you have to give up the legal control right away anyways.
Yeah, you do.
It's
and
just
that's what I'm saying.
Management can take a lot longer.
Yeah, and I think that's why we've seen immediate transfers, because usually I think at that point when they're ready to give up legal control, they're usually ready to immediately give up.
They're just saying that
control.
If you take gradual path instead of 36 months of transitioning the management, now you have 5 years to do it.
Yeah.
Right. Which then also extends all the other pieces that the puzzle that the kid now has to be involved in the business for a lot longer.
Yes, you can't just sell to a third party.
Yeah, you can't sell it for third party. So maybe let's look at 2 other scenarios where it can play out. I know that if a child, these things, anything can happen in life. The child could be, you have to keep the business running, you have to be active and all that stuff. What if the child cannot do it because they've got a mental illness or there's a disability or death?
Yeah.
Right? So the rules have...
I think they have a carve out for that.
They have a carve out for that where if you have a death, physical or mental disability, then the rules will still honor the fact that there's no disadvantage per se, right?
Yeah.
So that's a good thing.
Yes.
But at the same time, if you did somehow violated one of the rules to say, okay, I was supposed to hold these shares for 36 months in an immediate path or track, but you sold. The child receives a too good to be true offer. They may not be seeing the business their way and they don't want to be involved because they didn't like the business to be taken over.
Yeah.
And they sold.
Yeah.
And then so let's talk about what is the penalty, what's the downside, right? Let's play out a scenario where the child took over the business, immediate path or whatever, and just did not like being in the business. They wanted to be out.
Yeah, if they have like an amazing offer and they're just so tired of running the business.
Yeah.
Yeah, if you do it within that time frame, then CRA is going to treat that otherwise tax-free amount as a deemed
Up
dividend.
to lifetime capital gain exemption.
Up to the lifetime capital gain exemption. That amount that you had originally thought was tax-free is going to turn into a deemed dividend for tax purposes.
Taxable deemed
A
dividend.
taxable deemed
potentially,
dividend, potentially. And you can be looking at anything.
That's a disaster. Like
a 48% tax rate.
That's huge. Okay, so like, I mean, hopefully the children know what they're getting into, and that parents know that they are, that this will be not a test. Like they really know that the child is ready to take on and won't be just, regretting that decision of taking over the business and actually going through this transaction.
Yeah, it's really important to understand that there is this time frame that they're looking at to make sure that the business is still with the child within that.
Yeah.
36
there's
months.
other situations that I've always contemplated, like what if the business fails?
Yeah.
The child mismanaged it and then the business fails,
That would be very unfortunate in many different circumstances.
Yeah, because I think then it is what it is, right? Like,
it is what it is.
Yeah, like you can't predict what can happen. Business do wipe out all the time. Like, when COVID happened a few years ago, a lot of businesses had failed.
Yeah, they weren't able to sustain during that time.
Yeah, so I think, the parent may have been out of the business. Maybe they never get paid either, because if the parent said, well, pay me over time, I'll give you a promissory note.
Yeah, then they just run the business
runs
down
to the ground, and then that's unfortunate. Right? That's
in
a
many
real
different
risk.
places.
But that's a real risk of like.
It is a real risk, and I think a lot of parents would take that into consideration when giving up their business to their child.
They're giving to somebody who's capable.
Typically their child's involved and has shown that they can take over, hopefully, and then they would do that.
From there.
Yeah.
No, absolutely.
Okay, so we talked a lot about share sales.
Yeah.
What type of deals do you typically see? Do you see shares being sold, or do you see assets being sold, or do you see a hybrid?
Yeah. We spent a lot of time talking about a business sale by way of shares, but you can also sell a business by way of a corporation. We keep speaking corporation, but you could sell a business by way of selling the assets of the business, right? So be it equipment, whatever it is you need to run the business, equipment, the people, inventory, your system, process. You can always put values to each item separately, and then sell it to somebody as a basket of assets to someone. Now, for the reasons we talked about so extensively related to lifetime capital gain exemption, most deals in Canada, at least in my experience, right, I see 80 to 90% of the deals are done by way of share deals, because the seller is motivated to sell the shares of the company because they see lifetime capital gain exemption being a huge incentive that otherwise is not available if they sold the assets. Contrast this to an asset deal. If you were to sell assets, you could do that. You could sell the equipment, the customer list, the goodwill, etc. You can bucket each of these items and sell the basket of asset to someone else. But it also is a very more time-consuming deal in most part. Because when you sell a business, right, in form of shares, the company has everything in it. It's got the people, the employees, the contracts are signed, vendors are set. You basically selling a company that's ready to go, and just the ownership is changing, but it's not impacting the assets or how the business is run internally to the company, right? And that's much easier transition for a buyer who can come to buy the shares of the company, because just the ownership is changing. When you sell the asset deal, you have to potentially re-sign all your contracts with your employees. You have to potentially re-sign your contracts with your customers. There may be, and that on its own creates a lot of friction, because it might take a lot long to do that. Sometimes the licenses are at stake, where particular license that the company has is attached to the corporation only. And in transportation, for example, we had a client where Ontario had issued a CVOR, which is required for a transportation business. Well, it was attached to the company, right? and the buyer really wanted to buy the shares of the company. In that case, they weren't like going after the assets.
No. Yeah.
But I mean, there are times where like the buyer is encouraged, or more likely than not, want to prefer an asset deal. There are circumstances for that. And that could be like, well, if I'm buying real estate assets, I'm buying land, building, etc., why do I need a company, right?
Yeah.
You want to buy the asset directly because you can say it's a very real, because real estate transactions don't simply happen in form of share deals, because there are tax disadvantages. Your cost bases don't get stepped up when you actually, when you then have to sell the land and building later on, because if you did a share deal and you bought a land and building through that, well, you have a cost base in the shares, but you don't necessarily translate that into the land and building unless you did some post-closing.
So there's typically, when you buy the shares,
restructuring.
when you're buying the shares, you're buying the historical cost basis
Historical
of the
cost base.
assets. So
Yeah.
there's unrealized gains within the corporation.
Yeah, so if the company turned around and sold the land and building eventually, then
They
there's
would
gonna
realize
be
a
double
gain.
tax potentially,
Yeah.
right?
Yeah.
Now you can probably do some restructuring to reduce that kind of impact, but more commonly, land and buildings, if they're staying in a company, even though they qualify as a lifetime capital gain exemption, because the land and building is used in active business, more people prefer that they buy the actual land and building separately.
Yeah.
Right? There are other times like you want to buy an asset, such as we had that other instance where like someone wanted to sell a basket of royalties,
Yeah.
because they had an IP, intellectual property, which was earning a lot of royalty income, and that company just simply didn't qualify for lifetime capital gain exemption, just didn't have a business.
Yeah.
It was just literally an asset that generated royalties for them. So the buyer and the seller are okay to transact at the asset level. But to say that asset deals definitely are more involved because of all the friction that causes in all the reasons that I said before.
And sellers are more motivated to sell shares because they want access to their lifetime capital gain exemption.
Especially if there's lifetime capital gain exemption
Because
involved.
they don't have that. If they're selling the assets, like we said,
Yeah.
you have to sell shares of a qualified small business corporation. Yeah.
Yeah, I mean, I had run into one issue where we had a corporation that had the business in. I mean, this is the disaster. We had a corporation that had a business in it, like business that can be sellable, has value, can be sellable. Had whole special licenses that is attached to the company. It also has land and building that is not needed for the business. Also had life insurance in it.
Oh no.
Then that company owned another private company that had pretty much similar makeup. Like, what a disaster of like structure that the seller had.
Yeah.
And really, I mean, that's one deal in my experience in the recent times where the structure really killed the deal.
Yeah.
Right? Because the buyer really wanted the special licenses, and you could not operate the business without it. But then the seller wouldn't sell the shares because there's too much tax to pay.
There was no incentive to sell
remove the life
shares.
insurance, remove the
real estate,
remove another corporation that it owned, and truly that was a disaster of a file that we spent a lot of time on, across the table negotiating, looking at different scenarios. Ultimately, the deal died at the negotiation stages. And both buyer and seller spent a lot of money with advisors and whatnot, trying to come up with a solution. But none of them got to a place where it was a good compromise by either
So I think
party.
it's important also, we're talking about structuring, but when you're purchasing all these assets in this real estate and you're having these investments, to think about where you're putting them, right?
Well,
is it in your operating company? Is it a separate investing company? How is that set up?
Be cognizant, ask the right people to tell you where to buy assets, because these simple decisions that seem to be at the point when you're buying them become a huge blockers of your deal in the future.
And that can cost a lot of professional fees because you were involved in helping out.
I was involved. Like, we spent a lot of time trying to make this
Yeah.
work and just couldn't make it happen. And
Yeah.
that's like an example of like a bad structuring, but it can happen.
To summarize the conversation, the biggest takeaway is it's important to structure well in advance, to think about your exit 5-10 years out, and not to be planning your structure and thinking about your exit when you have a letter of intent come up, because there's a lot, like we spoke about, things to consider from a tax perspective, from an operational perspective.
Yeah, be prepared. Think about things, have foresight. Talk to your accountant, your tax advisor. They will lead you down the path of like, what are the options available? Look at different perspectives. Look at what you want.
Yeah. Think about what you want.
Think about what you want. What type of career do you want to have? What type of business exit? What type of legacy you want to have? And all the options available to you.
Yeah.
But then you make an informed decision, and also covering off all the other things, like making sure don't leave low-hanging fruits. Like make sure you use lifetime capital gain exemptions, not only yours but also all the other family members available to you. Credit proof the business. Don't leave your saving exposed to the business risk.
Yeah.
Don't leave assets in the company that the buyer would not want to buy. And
it doesn't have to be a lonely process. There's advisors out there that will prompt you and ask you the right questions to get to that end goal.
Yeah. And
it
you can
might
still
be
be busy.
confusing.
Yeah, it's like these are like big changes to the structure perhaps, but then it will save you, you spend thousands, but like it'll save you potentially millions in taxes and efficiency and like less headaches and smoother process down the line. Yeah. And I think you'll have a better experience all around. That's the takeaway for me.
That's the biggest takeaway.
Yeah.